Before we begin, please note that the information provided in this video is for educational and informational purposes only. I am not a licensed financial advisor, insurance agent, or medical professional. The world of health insurance is complex and specific to your individual circumstances, location, and needs. This presentation is not intended as a substitute for professional advice. You should always consult with a qualified and licensed professional before making any decisions about your health coverage. Let's be honest, there's a moment of dread that every single one of us with health insurance has felt. Picture this. You're at a weekend barbecue, you jump to catch a frisbee, and you land wrong. Your ankle screams. It's not a trip to the emergency room, but you know you need to get it checked out. So you head to urgent care. You flash your insurance card, feeling responsible, feeling covered. They wrap you up, give you some crutches, and send you on your way. You paid your premium this month and every month before it, so you think you're good. Then 3 weeks later, the bill arrives. An envelope that feels heavier than it should. You open it and your stomach drops. $750. For what? You have insurance. You call the number on the bill, confused and angry, and a polite voice on the other end says the words that have crushed millions of American budgets. Sir, the charges were applied to your deductible. That word, deductible. It's the monster under the bed of American healthcare. It's a giant, invisible wall of money you have to pay out of your own pocket before your insurance company decides to start meaningfully helping you. For millions of families, that wall is thousands of dollars high. $5,000, $8,000, even $15,000 for a family plan. It's a system that makes you feel like you're paying for a service you can't actually afford to use. It creates a terrifying game of chicken where you ask yourself, is this pain bad enough to risk a $1,000 bill? But what if that wall didn't exist? What if there was a type of health insurance where, from the very first dollar, you and your insurance company are in it together? No massive upfront barrier. No financial guesswork before you can see a doctor. This isn't a fantasy. It's called a Zero Deductible Health Insurance Plan. And understanding how it works, who it's for, and its hidden trade-offs could be the single most important financial decision you make all year. In this video, we are going to pull back the curtain on this often misunderstood corner of the health insurance world. We will demystify the jargon, expose the pros and cons, and give you the knowledge to determine if a zero-deductible plan is the key to unlocking financial peace of mind for you and your family. We're going to give you the power to stop feeling like a victim of your health plan and start feeling like an informed consumer in control of your choices. To truly understand the power of a zero-deductible plan, we first have to understand the battlefield. We need to dissect the components of a standard health insurance plan. I call them the four horsemen of healthcare costs: the premium, the deductible, the copay, and the coinsurance. Get these four and you'll get everything else. First up is the premium. This one's the easiest. Your premium is your monthly membership fee. It's the fixed amount you pay every single month to the insurance company just to keep your plan active. Think of it like your Netflix subscription or your gym membership. You pay it whether you use the service or not. If you go to the doctor 10 times or 0 times, that premium is coming out of your bank account. It's the cost of entry, the price for having the insurance card in your wallet. It doesn't pay for any specific medical service. It just keeps your coverage turned on. Now for the big one, the villain of our story, the deductible. The deductible is a specific, fixed amount of money that you must pay out of your own pocket for covered medical services before your insurance plan starts to pay. Let me say that again because it's the most misunderstood part of insurance. It is the amount you pay first. If you have a $5,000 deductible, you are on the hook for the first $5,000 of your medical bills for the year. Your insurance company basically sits on the sidelines keeping score until you've spent that amount. It's like having car insurance with a $5,000 deductible. If you get a small fender bender that costs $800 to fix, you pay the whole $800. The insurance company pays nothing. It's only when you have a catastrophic accident that costs $20,000 that your insurance kicks in, and even then, only after you've paid your first $5,000. That's how most health insurance works today. This high deductible is the primary reason people with insurance still go into medical debt. They can't afford that first giant hurdle. The third horseman is the copay. This is a little different and it can be confusing. A copay, short for copayment, is a fixed amount you pay for a specific covered healthcare service. For example, your plan might say you have a $30 copay for a primary care visit or a $75 copay to see a specialist. Think of it like a cover charge at a club. It's a flat fee you pay at the door just to get in, Now here's the tricky part. On many plans, especially high-deductible plans, these simple copays might not apply to everything. For many services like lab work, x-rays, or hospital stays, you'll pay the full cost of the service until your deductible is met. But for other plans, especially the zero deductible plans we're going to talk about, copays are how you pay for almost everything. It's a predictable flat fee that lets you know exactly what you'll owe before you even walk in the door. And that brings us to our fourth and final horseman, coinsurance. This one only shows up after you've conquered the deductible. Coinsurance is a percentage. It's the share of the costs of a covered healthcare service that you pay after you've met your deductible. It's usually expressed as a ratio, like 80/20ths or 70/30ths. The first number is what the insurance company pays, and the second number is what you pay. So, let's go back to our $5,000 deductible plan. Imagine you have a major surgery that costs $55,000. It's a big number, it's scary. Here's how it would work. First, you pay your $5,000 deductible. You pay every penny of that. That leaves $50,000 on the bill. Now your 80/20 coinsurance kicks in. The insurance company pays 80% of that remaining $50,000, which is $40,000. You are responsible for the other 20%, which is $10,000. So your total out-of-pocket cost for that surgery would be your $5,000 deductible plus your $10,000 coinsurance, for a grand total of $15,000. That sounds terrifying, right? It is. Which is why there's one final critical concept that acts as a safety net: the out-of-pocket maximum. This is arguably the most important number on your entire health plan. This is the absolute final most you will ever have to pay for covered services in a plan year. Once you've spent enough in deductibles, copays, and coinsurance to reach this number, the insurance company pays 100% of the cost for all covered services for the rest of the year. It's the financial stop-loss. It's the ceiling that protects you from total financial ruin in a worst-case medical scenario. So in our surgery example, if your plan's out-of-pocket maximum was, say, $8,000, your total bill would be capped at $8,000, not $15,000. You'd pay your $5,000 deductible, and then you'd pay $3,000 in coinsurance, and then you'd be done. The insurance company would have to cover the rest. So let's recap. You pay a premium every month no matter what. When you need care, you pay 100% of the costs until you hit your deductible. After you hit your deductible, you enter the cost-sharing phase where you pay coinsurance a percentage of the bill. Simple services might have a flat copay instead. And all of your spending is capped by the out-of-pocket maximum, your ultimate safety net. That is the system for 90% of health plans in America. It's a system built around a giant financial barrier, the deductible, that you must overcome alone. But the entire premise of a zero-deductible plan is to tear down that wall. Instead of a wall, imagine a partner standing right beside you from the very first dollar. Let's rewind. You're back on that hiking trail, that same crack of bone, that same searing pain. But this time you have a zero-deductible plan. The panic is still there. The physical pain is real, but the cold, creeping dread of the hospital bill is gone. Why? Because you know the moment you walk through those emergency room doors, your insurance is already working. You get to the hospital, check in, and they ask for your insurance card. You hand it over. They tell you, okay, your emergency room visit has a $250 copay. You swipe your credit card for $250. And that's it. For the visit itself, that is your entire contribution. You're not thinking about a $5,000 deductible. You're not mentally calculating if this trip will bankrupt you. You're focused on your leg. The doctors see you immediately. They do the x-rays, they confirm the break. A specialist comes in, a top orthopedic surgeon, and explains they need to set the bone and put you in a cast. You agree. You're not worrying if this specific doctor is in-network, and how much of their fee will go towards your massive deductible. You're just getting the care you need. A few weeks later, the bill arrives in the mail, but it's not a bill in the same way. It's an explanation of benefits and EOB, and looking at it is a completely different experience. You see the staggering numbers. The emergency room charge, $4,000. The x-rays, $800. The surgeon's fee, $6,000. The cast and supplies, $700. The total charge from the hospital is a whopping $11,500. Your heart might skip a beat for a second, a phantom feeling from your old high-deductible days. But then you look at the columns next to the charges. The column labeled amount you owe says zero. The column labeled amount paid by insurance, it says $10,750. and then you see a small separate line item. It's for the surgeon's fee. And on this plan, you have what's called coinsurance for specialist services. Let's say it's 10%. So you look at the surgeon's $6,000 fee. The insurance company has paid 90% of it, which is $5,400. Your share, the 10% coinsurance, is $600. So what did this entire catastrophic event cost you out of pocket? It was the $250 ER copay, plus the $600 coinsurance for the surgeon, a total of $850. Compare that to the $5,000 you would have paid on the other plan. With the high deductible plan, you paid 100% of the costs up to $5,000. With the zero deductible plan, you paid your small share, and the insurance company paid its massive share right from the very beginning. This is the fundamental difference. It's a concept called first dollar coverage. It means your insurance plan starts paying from the very first dollar of your medical expenses, not after you've paid thousands out of pocket. This completely rewires how you think about healthcare. The insurance company is no longer a silent, absent landlord who only shows up after the house has burned down. They are an active participant in your health from the moment you need them. So let's properly define those terms we just used, copay and coinsurance, in this new world. A copay or copayment is a fixed, flat fee you pay for a specific service. It's predictable. You know ahead of time that a primary care visit might be a $25 copay, a specialist visit might be a $50 copay, and an ER visit might be a $250 copay. It doesn't matter if the doctor's visit ends up costing the insurance company $100 or $500. Your price is fixed. It's like a cover charge to get into the club of healthcare. Once you pay it, you're in. Coinsurance is a little different. It's a percentage. Instead of a fixed fee, you pay a certain percentage of the total cost of a service. So if you have 20% coinsurance for hospital stays and your hospital stay costs $20,000, you would be responsible for $4,000. Now that sounds scary, and it can be, but this is where another crucial element of all health plans comes in: the out-of-pocket maximum. This is the absolute ceiling, the most you will ever have to pay for your share of medical care in a given year. In our broken leg example, if your out-of-pocket maximum was, say, $4,000, even if your 10% coinsurance calculated to more, you'd stop paying once you hit that $4,000 limit. The insurance company then pays 100% of everything else for the rest of the year. With a zero deductible plan, these two things, copays and coinsurance, are the only ways you share costs. There is no giant initial hurdle to clear. You are in the cost-sharing phase from day one. This changes behavior. Think about it. How many times have you had a nagging cough, a weird pain, or a suspicious mole and thought, "Ugh, I don't want to pay $150 just to have a doctor tell me it's nothing"? That's called financial hesitation. You are actively avoiding preventative or early-stage care because of the immediate cost. You are gambling with your health, hoping it's nothing serious, because your insurance plan has a financial barrier in front of it. A zero-deductible plan removes that hesitation. If you know that seeing your doctor is just a $25 copay, you're far more likely to go. You'll get that cough checked out. You'll ask about that weird pain. You'll get that mole looked at. And this can lead to catching serious problems earlier, when they are cheaper and easier to treat. It transforms healthcare from a reactive, emergency-only tool into a proactive, wellness-focused partnership. You're not just buying insurance for a catastrophe. You're buying access to the healthcare system itself. Now, the big question hanging in the air, the one you've been thinking this whole time. This sounds amazing, but it must be outrageously expensive, right? There's no such thing as a free lunch. And you're right. The trade-off for having no deductible, for having this first dollar coverage, is a higher monthly premium. That's the monthly fee you pay to the insurance company to keep your plan active. On the surface, the math seems simple. A high deductible plan might have a $300 monthly premium. A zero deductible plan might have a $600 monthly premium. And many people stop right there. They see that the zero deductible plan costs $300 more every single month, and they say, "No thanks, I'll take my chances." They choose the lower fixed cost, hoping they stay healthy and never have to face the higher variable cost of the deductible. But this is a dangerous oversimplification. It's a snapshot that ignores the bigger picture, the total potential cost over a year, because the monthly premium isn't the only number that matters. In fact, for many people, it's not even the most important number. The real calculation, the one that can save you from financial ruin, is far more nuanced. It requires you to look beyond the sticker price and understand your total financial exposure. That's the real number you should be worried about. And when you start to calculate that number, the true value of a zero-deductible plan begins to reveal itself in a way that is shocking, counterintuitive, and for many families, a financial lifesaver. So let's calculate that real number together. To do that, I want you to meet a hypothetical but very real American family. Let's call them the Millers. There's Mark, Sarah, and their 2 kids, 14-year-old Chloe and 12-year-old Leo. They live in a suburb. Mark has a decent job in IT. Sarah is a part-time graphic designer. They're comfortable, but they're not rich. They have a mortgage, a car payment, and they're trying to save for college and retirement. Sound familiar? It's open enrollment season, and they're staring at 2 health insurance options offered by Mark's employer. Option A is the High Deductible Health Plan, the HDHP. The monthly premium is pretty attractive. It's only $600 a month for the whole family. That's $7,200 a year. Feels manageable. But the family deductible is $8,000. After that, they pay 20% of the bills until they hit a family out-of-pocket maximum of $16,000. Mark looks at that low premium and thinks, we're all healthy. We barely go to the doctor. Let's save some money each month. It's a tempting thought. Option B is the Zero Deductible PPO plan. The monthly premium gives them sticker shock. It's $1,300 a month. That's $15,600 a year. More than double the HDHP. Feels like a punch to the gut. But there's no deductible. When they need care, they just pay a simple fixed copay. A $75 copay for the ER. A $40 copay for a specialist. A $500 copay for a hospital admission. And their out-of-pocket maximum is only $5,000. The Millers do what most of us do. They look at the premiums. The difference is $700 a month. That's $8,400 a year. They could put that money toward a vacation, pay down their car loan, or beef up their savings. The choice seems obvious. They sign up for the cheaper high-deductible plan. They feel smart. They feel like they've just saved themselves over $8,000. And for the first few months they were right. Nothing happens. They just pay their low premium and life goes on. Then comes a Saturday in October. Leo, their son, is the star of his soccer team. It's the regional semifinal. The game is tied. In the final minute, Leo makes a break for the goal. He collides with the goalie, and there's a sickening crack that everyone in the stands can hear. The next few hours are a blur of panic and pain. The ambulance ride. The chaotic emergency room. The x-rays confirm it. A severe compound fracture of his tibia. It's bad. He needs surgery. An orthopedic surgeon is called in. Leo is admitted to the hospital overnight. Mark and Sarah are terrified for their son, but in the back of their minds, another kind of fear starts to creep in. A financial dread. They have the good insurance, right? The one that was saving them money. Let's follow the money. Let's see what their smart decision actually costs them. First, the ER visit. The bill, after the insurance company's negotiated rate, comes to $2,500. Because the Millers have an $8,000 deductible, and they haven't spent a dime on healthcare all year, they are responsible for 100% of that bill. They write a check for $2,500. Their remaining deductible is now $5,500. Next, the orthopedic surgeon. His consultation and services before the surgery amount to another $1,500. Again, this is pre-deductible. The Millers pay the full amount. Their remaining deductible is now $4,000. So far, they are $4,000 out of pocket, and Leo hasn't even had his surgery yet. Then comes the big one. The surgery, the anesthesia, the one-night hospital stay. The total bill is a staggering $25,000. Now remember, they still have $4,000 left on their deductible. So they have to pay the first $4,000 of this bill themselves. Boom! Their $8,000 deductible is finally met. They've now spent a total of $8,000 out of their own savings account. But it's not over. It's never over with a high-deductible plan. Now coinsurance kicks in. Their plan pays 80%, but they are responsible for 20% of the rest of the bill. The bill was $25,000. They paid the first $4,000. That leaves $21,000. Their 20% share of that is $4,200. So for this single accident, the Millers have to pay the initial $4,000 in ER and specialist fees, plus the $4,000 to finish their deductible, plus the $4,200 in coinsurance. That's a grand total of $12,200. A $12,000 bill for one bad tackle on a soccer field. This is the bill that blindsides families. This is the bill that drains savings accounts and maxes out credit cards. This is the reality of a high-deductible plan when something actually goes wrong. Now let's rewind. Let's imagine the Millers were sitting at that same kitchen table during open enrollment, and despite the painful premium, they chose option B, the Zero Deductible plan. They grit their teeth and agreed to the $1,300 monthly payment. They're annoyed that $8,400 extra is coming out of their paychecks over the year. They feel like they're being ripped off. Then, that same Saturday in October happens. The same crack, the same ambulance, the same surgery. But for the Millers, the financial experience is completely, fundamentally different. They get to the ER. They show their insurance card. They are asked to pay their $75 copay. That's it. For the entire ER visit, the x-rays, the initial treatment, $75. The orthopedic surgeon sees Leo. His services are covered. They pay their $40 specialist copay. Leo is admitted for surgery. They are asked for their hospital admission copay. It's $500. This covers the room, the surgery, the anesthesia. The whole $25,000 event costs them a flat $500. After the surgery, Leo needs 10 sessions of physical therapy to learn to walk properly again. Each visit has a $40 specialist copay. So, 10 visits times $40 is $400. Let's add it up for the Zero Deductible family. $75 for the ER, plus $40 for the surgeon, plus $500 for the hospital, plus $400 for physical therapy. The grand total for the exact same accident, the exact same doctors, the exact same hospital, is $1,015. $1,015. Now let's look at the real number. The total cost for the year. For the Millers with the cheap high-deductible plan, their annual premium was $7,200. Their out-of-pocket costs for the accident were $12,200. Their total financial exposure for the year, $19,400. For the Millers with the expensive Zero Deductible plan, their annual premium was $15,600. Their out-of-pocket costs were $1,015. Their total financial exposure for the year, $16,615. By choosing the plan with the scary high premium, the Millers would have actually saved almost $3,000. But more importantly, they would have saved themselves from the terror of that $12,000 surprise bill. They would have paid their predictable copays and focused on what really mattered: their son's recovery. There would have been no hesitation. No sitting in there wondering, how much is this going to cost us? No sleepless nights staring at the ceiling, trying to figure out which credit card to put the hospital bill on. The value of a Zero Deductible plan isn't just in the final math. It's in the predictability. It's in the peace of mind. It transforms insurance from a financial gamble into a straightforward, usable service. You pay a high but fixed and predictable price every month, and in return the financial devastation of a medical emergency is taken off the table. You are protected from the catastrophe. That is the counterintuitive truth. The plan that feels more expensive month to month can be the one that saves you from financial ruin. So let's pull back the curtain. How does this actually work? How does a plan with a higher monthly bill become the very thing that stands between you and a financial nightmare? It works by eliminating the single biggest barrier to care in the American health insurance system: the deductible. Imagine this scenario. Let's call our subject Emily. Emily is a 32-year-old graphic designer. She's healthy, active, but she's also pragmatic. She chose a Zero Deductible health plan. Her monthly premium is, let's say, $200 more than her friend who chose a high-deductible plan. Her friend teases her a bit, saying she's overpaying for insurance she never uses. Emily just smiles. She's not buying insurance for the good days. She's buying it for the one bad day. And one Tuesday, that day arrives. She's out for a run, trips on an uneven sidewalk, and feels a sickening crack in her ankle. The pain is immediate and overwhelming. An ambulance is called. At the emergency room, they confirm it's a bad break, a trimalleolar fracture, requiring surgery. Now let's trace the money. This is where the magic, or rather, the simple math of a Zero Deductible plan, comes into play. When she checks into the ER, she pays her ER copay. A copay is a flat fee you pay for a specific service. It's predictable. Let's say her ER copay is $300. She pays it. That's it for the ER visit itself. Next, she needs to see an orthopedic surgeon to set the bones. That's a specialist visit. Her plan has a specialist copay. Let's call it $75. She pays that. Then comes the surgery, the anesthesia, the hospital stay for 2 nights, the physical therapy. The bills start rolling in, and they are astronomical. The surgeon's bill is $15,000. The anesthesiologist is $4,000. The hospital stay with imaging and medication is $35,000. The total bill is a staggering $54,000. If Emily had a high deductible plan, this is the moment of sheer panic. This is where she would have to start writing checks from her savings account, draining it dry until she hit her deductible of, say, $8,000. She would be on the hook for the first $8,000 of that $54,000 bill before her insurance company paid a single cent. But Emily has a zero deductible plan. Because her deductible is zero, her insurance starts sharing the cost from the very first dollar. This is where the next term comes in, coinsurance. Coinsurance is the percentage of the cost you share with your insurance company after your deductible has been met. For Emily, her deductible is already met because it's zero. Her plan might have an 80-20 coinsurance split. This means the insurance company pays 80% of the covered costs, and Emily is responsible for 20%. So, on that $54,000 bill, the insurance company immediately picks up 80%, which is $43,200. Emily is responsible for 20%, which is $10,800. Now, you might be thinking, $10,000 is still a huge amount of money, and you are absolutely right. But this is where the final and most important safety net of her plan kicks in. The out-of-pocket maximum. The out-of-pocket maximum is the absolute, rock-solid ceiling on what you will have to pay for covered medical expenses in a single year. It's the circuit breaker that prevents a true financial catastrophe. Let's say Emily's out-of-pocket maximum is $6,000 for the year. Let's recalculate. She paid the $300 ER copay. She paid the $75 specialist copay. That's $375 she's already paid. Now we look at her 20% share of the big bill, which was $10,800. Does she have to pay all of that? No. She only has to pay her share until her total spending for the year hits that $6,000 maximum. She's already paid $375. So she only needs to pay another $5,625 towards that massive bill. Once she pays that, she has officially hit her $6,000 out-of-pocket maximum for the year. The grand total she is responsible for is $6,000. Not $54,000, not $10,000, $6,000. And here's the most powerful part. For the rest of that calendar year, from that moment forward, her insurance company pays 100% of all covered medical costs. If she needs more surgery, more physical therapy, more specialist visits, more prescriptions, it's all covered. Her financial obligation for her health is done for the year. She can now focus on one thing and one thing only, healing. Now let's rewind and put Emily's friend, the one with the high deductible plan, in that same ambulance. Let's call him Mark. Mark pays a lower premium every month and he has a health savings account or HSA, which is great. His plan has an $8,000 deductible and an $8,000 out-of-pocket maximum. Same accident, same surgery, same $54,000 bill. Mark gets to the hospital. The billing department looks at his plan and sees he hasn't paid anything towards his deductible this year. So, for that $54,000 bill, Mark is responsible for the first $8,000. Period. He has to write a check or drain his HSA, or put it on a credit card. He has to come up with $8,000 before his insurance company helps at all. Only after he has paid that $8,000 does his coinsurance kick in on the remaining $46,000. In his case, since his deductible and out-of-pocket max are the same, once he pays the $8,000, he's done. So let's compare. Emily's total cost for the accident was $6,000. Mark's total cost was $8,000. Yes, Emily paid more in premiums all year. Let's say she paid that extra $200 a month. Over 12 months, that's $2,400. So, her total all-in cost for the year is her premiums plus her $6,000 out of pocket, versus Mark's lower premiums plus his $8,000 out of pocket. Depending on the exact numbers, they might come out pretty close in a year with a major medical event. But the real difference isn't just the final number. It's the experience. It's the psychology. A zero-deductible plan is designed for predictability and peace of mind. You know your worst-case scenario from day one. You know that if you need to go to the doctor for a sinus infection, it's a simple, predictable copay. You're not thinking, Well, this visit is going to cost me $250 out of pocket that I have to pay in full because I haven't met my deductible. This encourages people to seek care earlier, before a small problem becomes a big, expensive one. You are, in essence, prepaying for your potential healthcare needs on a monthly installment plan. You are smoothing out your financial risk over 12 months, instead of facing a giant, terrifying wall of debt all at once. This is the fundamental trade-off. It's a choice between two philosophies of risk management. Do you want to pay more each month to know that a medical emergency will be a manageable expense rather than a financial crisis? Or do you want to pay less each month, save the difference, and carry the risk that you might have to suddenly come up with thousands of dollars on your own? There is no single right answer, but understanding this choice is the first step toward mastering the system. The Zero Deductible plan is for the person who wants to transfer as much of that immediate financial risk as possible to the insurance company. They are willing to pay a premium for that certainty. But on the other side of that coin is the person who chooses a high deductible plan. Let's call them the calculated risk taker. This person is often younger, healthier, and has a solid emergency fund saved up. They look at the high monthly premium of a zero deductible plan and think, I'm paying a huge amount of money every single month for a what-if scenario that probably won't happen. They're betting on their own health. They're willing to take on the initial financial risk of a medical event in exchange for a much, much lower monthly premium. This frees up hundreds of dollars in their budget each month, money they can invest, save, or use for other expenses. They are essentially self-insuring for the first few $1,000s of care, and they're comfortable with that gamble. To really understand the difference, let's put these two people into the real world. Let's call our zero deductible plan holder Predictable Paula, and our high deductible plan holder, Calculated Risk Chris. Both are 35 years old working professionals, but they've made opposite choices in their health insurance. Paula pays a hefty $700 a month for her zero deductible plan. Chris pays a lean $250 a month for his plan, which has a $5,000 deductible. Scenario 1. A simple checkup. Paula wakes up with a sore throat and a cough. She schedules a visit with her primary care physician. She goes to the appointment, sees the doctor, gets a prescription for an antibiotic. At the front desk, she pays her $25 copay. That's it. The visit, the test, the doctor's time, it was all covered after that predictable flat fee. She doesn't have to think about the real cost of the visit. It's just $25. Now let's look at Chris. He gets the same sore throat. He goes to the same doctor. But when he gets to the front desk, his experience is totally different. The receptionist tells him the insurance company's negotiated rate for this visit is $150. Since Chris hasn't spent anything on healthcare this year, he hasn't met any of his $5,000 deductible, so he has to pay the full $150 out of his own pocket. That money now counts toward his deductible, but for a simple visit, he paid 6 times more than Paula did at the point of service. Right away you can see the appeal for Paula. Her cost was known, small and simple. Chris's cost was higher, and he had to foot the entire bill himself. But now let's raise the stakes. Scenario 2. A weekend accident. Paula is out for a bike ride, hits a patch of gravel and takes a nasty fall. She thinks she broke her wrist. She goes to the emergency room. They do an X-ray, confirm it's a fracture, and put her in a cast. The total bill for the ER visit, the radiologist, the physician, and the supplies comes to $4,000. It's a scary number. But Paula has a zero deductible plan. Her plan might specify a $250 copay for an emergency room visit. So, after the dust settles, she pays her $250 copay. The remaining $3,750? The insurance company pays that. Her financial exposure was capped at a predictable, manageable amount, even in an emergency. Now what happens to Chris? Same bike, same fall, same broken wrist. He goes to the same ER and gets the same $4,000 bill. But Chris has that $5,000 deductible. He hasn't met it. So, who pays that $4,000 bill? Chris does. All of it. In one afternoon, his calculated risk didn't pay off. He's now on the hook for a bill that is more than a year's worth of his premium savings over Paula. He now only has $1,000 left to meet on his deductible for the rest of the year, but that's cold comfort when he's staring at a massive unexpected expense. This is the exact scenario that people who buy zero deductible plans are paying to avoid. They are paying for peace of mind against the financial shock of an accident or sudden illness. This brings us to the most important question. Who are these plans actually designed for? Who is the ideal candidate for a zero-deductible plan? The answer isn't just people who hate risk. It's for people who can reasonably predict they will use the healthcare system. First, individuals and families managing chronic conditions. Think about someone with type 1 diabetes. They need regular visits with an endocrinologist. They need a constant supply of insulin, test strips, and pump supplies. Or someone with Crohn's disease who requires expensive biologic infusions every few weeks. For these individuals, healthcare isn't a what if, it's a what is. They know for a fact they will have significant medical expenses every single year. A zero-deductible plan allows them to budget for their healthcare with incredible accuracy. They pay their high premium, their predictable copays for doctor visits and prescriptions, and that's it. There's no giant deductible barrier at the beginning of the year preventing them from getting the life-sustaining care they need. For them, a high-deductible plan would be a financial nightmare, forcing them to pay thousands out of pocket before their real coverage even begins. Second, families with young children. Little kids are magnets for germs and minor injuries. It's a constant stream of pediatrician visits for ear infections, strep throat, mystery rashes, and the annual flu. Then there are the trips to urgent care for a sprained ankle from soccer practice or a cut that needs a few stitches. For parents, the predictability of a simple copay for each visit can be a massive relief. Instead of worrying about a $150 bill every time a child gets sick, they know it's just their $25 or $30 copay. It removes the financial friction from seeking care, ensuring their kids get the attention they need when they need it. Third, anyone who is planning on becoming pregnant. The costs associated with prenatal care, delivery, and postnatal care in the United States are astronomical. We're talking tens of thousands of dollars for a routine pregnancy and delivery. With a zero-deductible plan, these costs become manageable. The numerous OB/GYN appointments, the ultrasounds, the blood tests, they're typically covered by a simple copay. The hospital delivery itself will be subject to the plan's cost sharing, but without a massive deductible to pay down first, the family's out-of-pocket expense is significantly lower and more predictable during one of the most financially and emotionally demanding times of their lives. And finally, as we've mentioned, there are the people who are simply risk-averse. They may be perfectly healthy, but the anxiety of a potential $5,000 surprise bill is something they can't live with. They view the higher premium not as an expense, but as an investment in their own mental well-being. They are buying certainty in an uncertain world. So the zero-deductible plan clearly offers a powerful value proposition, predictability and protection from upfront costs. But it all comes at a price, and that price is the premium. This is the fundamental trade-off of all health insurance, brought into its sharpest focus here. You are prepaying for your potential healthcare needs. The insurance company is taking on 100% of the initial risk. If you break your leg on January 2nd, they are on the hook for thousands of dollars after you've only paid them 1 month's premium. To make that business model work, they have to charge a premium that is high enough to cover the costs of all the policies in their pool of customers, knowing that many of the Chris's are opting for cheaper plans. Think of it like this. A high-deductible plan is like a basic car insurance policy that only covers major collisions. It's cheap, but if you get a fender bender, you're paying for it yourself. A zero-deductible health plan is like a bumper-to-bumper, all-inclusive premium warranty on that same car. It covers everything from a major engine failure down to a tiny scratch on the door. It costs a lot more to buy that warranty, but you drive off the lot knowing that almost nothing that happens will result in a surprise bill. You've paid for that peace of mind. But what if I told you that high premium isn't the only hidden cost? What if that feeling of total protection was not entirely accurate? Because there's another layer to these plans that most people completely miss. A detail buried in the fine print that can make or break your financial health, even with a $0 deductible. And that's the world of copays and coinsurance. They sound similar, but they operate in vastly different ways, and understanding that difference is the key to truly knowing what your plan will cost you. Let's start with the copay or copayment. Think of it as a cover charge for healthcare. It's a fixed, flat fee you pay for a specific service, and you pay it right at the front desk before you even see the doctor. It's predictable. It's simple. Your insurance card might even have the amounts printed right on it. $30 for a primary care visit, $75 for a specialist, $250 for an emergency room visit. The key word here is fixed. Whether you're seeing the doctor for a 5-minute checkup or a 45-minute consultation about a complex issue, that copay is the same. It doesn't matter what the doctor's total bill is. If the copay is $30, you pay $30. The insurance company handles the rest of the negotiated bill for that specific visit. This is the beauty of the copay model, and it's a cornerstone of most zero-deductible plans. It provides cost certainty. You can budget for your health care. You know that if you need to see your family doctor 3 times this year, it's going to cost you $90 in copays, period. There are no surprise calculations, no scary percentages. You pay your fee, you get your care. It's a clean, straightforward transaction. But health insurance is rarely that simple. And this is where the copay's much more complicated and potentially terrifying cousin comes into play: coinsurance. If a copay is a fixed cover charge, coinsurance is a percentage of the final bill. It's not a flat fee. It's a portion of the total cost of a service that you are responsible for after your insurance company has paid its part. The most common split you'll see is an 80/20 plan. This means after you've met your deductible, which in our case is zero, the insurance company pays 80% of the cost of your medical care, and you pay the remaining 20%. And that 20% can be a very, very big number. Let's put this into perspective. Your $30 copay for a doctor's visit is manageable. But what happens when you need something more serious? Let's say your doctor orders an MRI. An MRI doesn't have a simple copay. Instead, your plan says you have 20% coinsurance for advanced imaging. The full cost of that MRI, after the insurance company's negotiated discount with the imaging center, is $2,000. Your share, your 20% coinsurance, is $400. That's a lot more than a $30 copay. Now let's dial up the stakes. Imagine you have a medical emergency. You're rushed to the hospital and need surgery, followed by a 3-day stay to recover. The total bill for the surgeons, the anesthesiologist, the hospital room, the medications, the tests, it all comes to $50,000. This is not an exaggeration. This is a routine cost for a common procedure in the American healthcare system. Your plan has a $0 deductible, which is great. You don't have to pay a few $1,000s before your benefits kick in. They kick in right away. But your plan has 20% coinsurance for hospitalization and surgery. So, your share of that $50,000 bill is 20%. That's $10,000. Suddenly, that $0 deductible doesn't feel so comforting, does it? You went from a world of predictable $30 fees to a sudden shocking $10,000 liability. This is the hidden danger lurking behind many zero-deductible plans. The absence of a deductible often means you are exposed to coinsurance percentages right from day one. And for high-cost services, that exposure can be financially devastating. This is how people with good insurance can still end up with crippling medical debt. They understood the premium. They understood the zero deductible. They understood their $30 copays. But they never truly grasped the brutal math of coinsurance until a massive bill arrived in the mail. So, are you just completely exposed? Is there nothing to stop that 20% from bankrupting you if you get truly sick? Thankfully, there is. There is one final critical piece of the puzzle that acts as your ultimate financial shield. It's arguably the most important number on your entire health insurance policy. Even more important than the deductible. It's called the out-of-pocket maximum. The out-of-pocket maximum, or OOPM, is exactly what it sounds like. It is the absolute rock-solid ceiling on what you will be forced to pay for covered medical services in a given year. It is your financial safety net. Once you have paid enough in deductibles, copays, and coinsurance to reach your out-of-pocket maximum, your insurance company is legally required to pay 100% of all your covered medical costs for the rest of the plan year. You don't pay another dime in cost sharing. Let's go back to our surgery example. The bill was $50,000, and your 20% coinsurance was a terrifying $10,000. But let's say your plan has an out-of-pocket maximum of $8,700, which was the individual maximum for ACA plans in 2023. Before the surgery, maybe you had paid a few $100s in copays and other small bills throughout the year. Let's say you've paid $500 so far. When that $10,000 coinsurance bill hits, you don't actually have to pay all of it. You only have to pay enough to reach your $8,700 limit. Since you already paid $500, you would owe another $8,200. Once you pay that, you have officially hit your out-of-pocket maximum for the year. The insurance company is now on the hook for the rest of that surgery bill, and for any other covered medical care you need until your plan renews. If you needed another $100,000 procedure a month later, your cost would be zero. The insurance pays everything. This is why understanding the relationship between these three components is so vital. Your deductible is the first hurdle. On a zero-deductible plan, you clear it instantly. Then you enter the world of cost-sharing, paying for your care through either predictable copays for small services or potentially massive coinsurance for big ones. And all of those payments, the deductible, even if it's zero, your copays and your coinsurance are tallied up. They all count towards your out-of-pocket maximum, which acts as that final firewall protecting your life savings from a medical catastrophe. The one thing that doesn't count towards your out-of-pocket maximum? Your monthly premiums. Those are the fixed cost of just having the plan, and you pay them no matter what. So the out-of-pocket maximum is your hero, your ultimate protection. It's the number that lets you sleep at night, knowing that even in a worst-case scenario, there is a limit to your financial bleeding. But this hero has a critical weakness, an Achilles heel that insurance companies count on you not understanding. This entire safety net, this entire system of copays, coinsurance, and out-of-pocket maximums operates on one fundamental assumption: that the doctors you see and the hospitals you visit are in-network. The moment you step outside that approved network of providers, the rules don't just change, they can be thrown out the window entirely. That $8,000 safety net? It could vanish in an instant, leaving you exposed to the full, uncapped, terrifying cost of American healthcare. And navigating this in-network versus out-of-network world is the next great challenge we have to conquer. To understand this, you have to think of your health insurance company not as a safety net, but as the manager of an exclusive, members-only club. And the doctors, hospitals, and labs? They're the club's facilities. When you buy a plan, you're not just buying coverage, you're buying a membership card to a very specific club. This club is called the network. Behind the scenes, long before you ever sign up, your insurance company goes to war on your behalf. They march into the offices of massive hospital systems and say, "Look, we have 2 million members in this state. We can send them all to your competitor down the street, or we can send them to you. If you want our business, you need to give us a massive discount. We're not paying your sticker price of $1,000 for an MRI. We'll give you $300. Take it or leave it." The hospital, wanting access to those 2 million potential patients, almost always agrees. They sign a contract. They agree to a secret, heavily discounted price list for hundreds, even thousands of procedures. This negotiation happens with every single entity: primary care doctors, specialists, labs, imaging centers. The result is a web of contracts, a financial ecosystem. That's the network. When you stay in network, you are playing the game by the club's rules. You are accessing the facilities that have agreed to the secret handshake and the discounted prices. This is where your zero-deductible plan becomes a superpower. Let's imagine Sarah. She has a zero-deductible plan. She develops a persistent, nasty cough and her doctor recommends a chest CT scan. She logs into her insurance portal, types in CT scan, and finds an imaging center 3 miles away that is listed as in-network. She goes, gets the scan, and the person at the desk asks for her $25 specialist copay. That's it. She's done. Now let's look at what happened in the background. The imaging center's normal public-facing price for that CT scan might be $2,000. But because of their network contract, the negotiated rate with Sarah's insurance is only $600. Sarah paid her $25 copay. The insurance company pays the remaining $575. Sarah met zero deductible. She simply paid her small fixed fee, and the massive discount machine of the network did the rest. It was predictable, affordable, and seamless. That is the promise of a zero-deductible plan working perfectly. But what happens if you step outside the club? Let's meet Mark. Mark has the exact same zero-deductible plan as Sarah. He has the same nasty cough. But his neighbor, a very convincing guy, tells him about this amazing independent imaging center across town. They have the newest machines, the best technicians, he says. Mark, wanting the best, doesn't bother to check his insurer's website. He just books the appointment. He goes to the fancy out-of-network center. He gets the same CT scan. But when he gets to the front desk, they don't ask for a $25 copay. They say, "That will be $2,000. Mark is stunned. He says, "But I have insurance. A zero-deductible plan." The receptionist nods sympathetically and says, "We can give you the paperwork to submit to your insurance for reimbursement, but we don't have a contract with them, so you have to pay our full rate up front." Mark, trapped, pays the $2,000. He submits the claim to his insurance, expecting a check for $1,975 in the mail. But that's not what happens. His insurance company receives the claim and their system immediately flags it. Out of network. The plan's rules for out-of-network care are completely different. First, they ignore the $2,000 charge. They say, "We have determined that the usual and customary rate for this procedure in your area is $600. That is the most we will consider for reimbursement." But it gets worse. Mark pulls up the fine print of his plan. His amazing $0 deductible only applies to in-network care. For out-of-network services, he has a completely separate secret deductible of $8,000. So the insurance company looks at the $600 customary charge. They see Mark has paid $0 toward his $8,000 out-of-network deductible, and so the amount they reimburse him is zero. Nothing. Not a single cent. Mark is out the full $2,000. His zero deductible plan, his supposed financial shield, was completely and utterly useless. He didn't just step outside the club. He walked into a financial minefield. By going to a provider that hadn't signed that secret contract, he forfeited all the benefits he was paying for. Now you might be thinking, okay, I get it. I just have to be careful and always stay in network. That's simple enough. But what if you don't have a choice? This brings us to the most terrifying, insidious trap in American healthcare: surprise medical billing. Imagine Sarah again. This time, she's in a serious car accident. An ambulance rushes her to the nearest major hospital. On the way, she or a family member has the presence of mind to check, and they're relieved. The hospital is in network. Great. She's rushed into surgery to repair a broken leg. The surgeon who operates on her is an employee of the hospital. He's in network. The operating room, the nurses, the hospital bed, she recovers in, all in network. She's following the rules. She expects to pay her hospital copay, maybe some coinsurance, but it should be manageable. Her zero deductible plan has her back. Then, 6 weeks later, the bills start arriving. Not from the hospital, but from unfamiliar company names. One is from Apex Anesthesiology Group, for $5,000. Another is from Metropolitan Radiology Associates, for $2,000. Sarah's confused. She calls her insurance company, and they deliver the devastating news. "Ma'am, while the hospital and your surgeon were in network, the anesthesiologist who administered your epidural during surgery is part of an independent physician group. They don't have a contract with us. They are out of network." And the radiologist who read her initial x-rays in the ER? Same story. An independent contractor. Also out of network. Suddenly, Sarah is in the same nightmare scenario as Mark, but she did nothing wrong. She was taken to an in-network hospital in an emergency. She had no way of knowing, and certainly no ability to choose, which anesthesiologist was on call that day. She was literally unconscious when she received the most expensive part of her care. The $5,000 bill from the anesthesiologist? Her insurance applies its out-of-network rules. They decide the customary rate is only $1,000, and since she hasn't met her $8,000 out-of-network deductible, they pay zero. The anesthesiology group then legally comes after Sarah for the full $5,000. This is called balance billing. Billing the patient for the balance the insurer won't pay. Her zero deductible safety net wasn't just useless. It was a mirage. It protected her from the hospital bill, but left her completely exposed to these phantom providers who floated through her care, unseen and unvetted. Now, a federal law called the No Surprises Act has been put in place to fight this exact scenario in emergencies. But the system is still riddled with loopholes and compliance is spotty. It doesn't protect you if you, like Mark, consciously choose an out-of-network provider. It proves a fundamental, terrifying truth. Your plan's network isn't just a list of suggestions. It is an invisible cage. And the financial consequences for rattling the bars, intentionally or not, can be catastrophic. The value of your zero-deductible plan is therefore not just about the dollar amount. It is directly tied to the type and quality of the network it gives you access to. And this is where we find the next great fork in the road, the choice that will define your entire healthcare experience. The difference between an HMO, a PPO, and an EPO. Because choosing the wrong one can turn your amazing zero-deductible plan into a golden ticket to nowhere. So let's break this down. Imagine you've just been handed the keys to a brand new car. It's got a zero-deductible plan, which is like having a full tank of gas that magically refills itself. You feel unstoppable. But then you look at the dashboard and see 3 different GPS options: HMO, PPO, and EPO. You think, they all get me to the hospital, right? What's the difference? Well, one is a meticulously planned subway system. One is an all-access taxi service. and one is a citywide bus network. Picking the wrong one means that even with a full tank of gas, you might not be able to get where you need to go. First up, the HMO, the Health Maintenance Organization. Think of this as the subway system. It's efficient, it's organized, and it's typically the most cost-effective way to get around the city of healthcare. But it has very strict rules. The most important rule is that you must choose a station master, your primary care physician or PCP. This doctor is your gatekeeper, your home base. You cannot go anywhere else on the subway map without first checking in with your PCP. If you have a weird rash, you see your PCP. If your knee is acting up, you see your PCP. If you think you need to see a heart specialist, a cardiologist, you can't just book an appointment. You must go to your PCP first, who will then evaluate you and give you a referral, which is like a special transfer ticket to get on the specialist line. This is the core of the HMO model. Coordinated care. Your PCP is the conductor of your health orchestra, making sure the violins aren't playing a different tune than the cellos. This prevents you from getting redundant, expensive tests and ensures one person has the full picture of your health. The other massive rule of the HMO subway is that it is a closed loop. It only serves the stations, the doctors and hospitals within its network. If you decide to go to a doctor who isn't on the map, the subway system doesn't recognize them. Your ticket is worthless. With very few exceptions for a true life-threatening emergency, if you go out of network on an HMO, you pay for 100% of that bill yourself. Your zero deductible plan means nothing out there. So the trade-off is clear. In exchange for lower monthly premiums and predictable costs, you give up freedom. You follow their map, their rules, and you stay on their tracks. Now let's look at the PPO, the Preferred Provider Organization. This is the city's luxury taxi service. You are in the driver's seat. You want to go to that fancy dermatologist across town you saw on Instagram? Go for it. You think you need to see a neurologist? Just call and make an appointment. There is no gatekeeper. There is no PCP requirement. You don't need a referral for anything. You have complete freedom to choose your own path. And here's the biggest difference. The PPO taxi service will take you anywhere, even to destinations off the map. The PPO has a preferred network of doctors and hospitals, and when you stay within that network, you get the best rates. Your zero deductible works perfectly, you pay your small copay, and you're on your way. But if you decide to see a doctor who is out of network, the PPO will still help you pay for it. The meter just runs much higher. Instead of a simple copay, you will now have a separate out-of-network deductible. And this deductible is often thousands or even tens of thousands of dollars. After you meet that, the insurance might only pay 60 or 70% of the bill, leaving you with the rest. So while you have the freedom to go anywhere, that freedom comes at a premium, both in your higher monthly payments and in the potentially massive costs if you venture outside the preferred routes. The PPO is for people who value choice above all else, who may have a chronic condition that requires seeing very specific specialists, or who simply want the peace of mind of knowing they are covered, no matter where they go. Finally, we have the hybrid, the EPO, the Exclusive Provider Organization. Think of this as the city bus system. Like the PPO taxi service, you don't need a bus dispatcher, a PCP, to tell you which route to take. You also don't need a transfer ticket or a referral to get on the express bus to the specialist's office. You have the freedom to choose any stop on the map and go there directly. This gives you more flexibility and direct access than the rigid HMO subway system. But here is the critical catch, and it's right there in the name. Exclusive. The EPO bus system will only take you to stops within its exclusive network. If you try to visit a doctor or hospital that isn't an official bus stop, you are on your own. Just like an HMO, there is no out-of-network coverage at all, except for a true emergency. So the EPO tries to give you the best of both worlds. The lower premiums associated with a limited network, combined with the freedom to see specialists without a referral. It's a fantastic option for people who hate the gatekeeper model of an HMO, but don't want to pay the sky-high premiums for a PPO they might never fully use. The risk, of course, is that you are betting that every single doctor, specialist, and hospital you could ever possibly need is located on that bus route. If you're healthy, live in a major metro area with a large EPO network, and value direct access, it can be a perfect fit. So how does this choice transform your zero deductible plan? It's everything. A zero deductible HMO is a golden ticket, but only to the rides inside one specific theme park. It's incredibly affordable and simple, as long as you're happy staying within the park walls. A zero deductible PPO is like an all-access VIP pass to every theme park in the country. It's amazing, but you're paying a lot for that privilege every single month. And remember, your zero deductible only applies to the preferred parks. If you visit an out-of-network park, you'll have to pay a separate, huge entrance fee before your VIP pass even starts to help. And a zero deductible EPO is like a season pass to a very large, very nice theme park. You can go on any ride you want without waiting in the referral line. But the moment you step outside the gates, your pass is just a piece of plastic. Consider the story of two people, both with zero deductible plans. First, there's David. He chose an HMO to save money. He felt brilliant. No deductible, low premium. Then, he got a rare diagnosis. The leading expert, the one doctor who had pioneered a new treatment, was in another state and, of course, not in his HMO's rigid network. David was faced with an impossible choice. Accept the standard, less effective treatment from a doctor inside his network, or find a way to pay $250,000 out of pocket to see the best. His zero deductible plan had become a golden cage. Then there's Maria. She paid the high premiums for a PPO. Her friends with HMOs teased her for wasting money. But when her son developed a complex heart condition, the best pediatric cardiac surgeon was at a hospital 2 hours away, and it was out of network. It was a stressful, financially terrifying ordeal. They had to first meet a massive $10,000 out-of-network deductible. But after that, the insurance picked up 70% of the astronomical bills that followed. It still cost them a fortune, but it didn't bankrupt them. It saved them. The higher premium she paid every month wasn't for healthcare. It was for the ability to choose. It was for that one catastrophic what-if moment. Choosing between HMO, PPO, and EPO isn't a financial decision. It's a life philosophy decision. It's a bet on your future health, your tolerance for risk, and your desire for control. But even after you've made this monumental choice, your journey isn't over. You've picked your car and your GPS. You see that gleaming zero on the deductible gauge. But there are other dials on the dashboard with names like copay, coinsurance, and out-of-pocket maximum. And ignoring them is like ignoring your oil light, because these are the three numbers that can still cause your financial engine to seize, leaving you stranded on the side of the road. So let's meet Mark. Mark is a smart guy. He's a graphic designer, he's healthy, he works out. When it was time for open enrollment at his company, he saw the zero deductible plan and his eyes lit up. The premium was higher, sure, but the logic seemed flawless. Pay more each month, and when something actually happens, you pay nothing. It felt like buying the VIP pass at an amusement park. You pay more at the gate, but you get to skip all the lines. He thought he'd found a cheat code to the American healthcare system. For the first 6 months, he was right. He went for his annual physical. Covered. He got a flu shot. Covered. He felt invincible, smugly telling his friends who were grumbling about their own $4,000 deductibles that they were doing it all wrong. Then came the Saturday morning basketball game. Mark goes up for a rebound just like he's done 1,000 times. But this time he comes down on someone else's foot. He hears a sickening pop, and a hot searing pain shoots up his leg. He can't put any weight on it. His friends help him hobble to his car, and he drives himself to the nearest in-network urgent care clinic. As he checks in, clutching his swollen ankle, he pulls out his insurance card like a golden ticket. He's in pain, but in the back of his mind he's thinking, "Thank God I have the good insurance. This won't cost me a thing." The receptionist smiles, types his information into the computer, and then says the 5 words that start the avalanche. "That'll be a $75 copay." Mark blinks. "A copay? But I have a zero deductible plan." The receptionist gives him a practiced, sympathetic look. "Yes, sir. Your plan has a $75 copay for specialist visits and urgent care." Mark is confused. He thought zero deductible meant zero cost. But he's in too much pain to argue. He pays the $75. It's annoying, but it's less than $100. A small crack in his financial armor, but just a crack. The doctor examines him, suspects a ligament tear, and orders an MRI. A week later, Mark is sliding into the giant magnetic tube. No one asks him for money. He leaves feeling reassured. The $75 copay must have just been a one-time fee for the visit itself. The expensive stuff, the real medical care like this MRI, that's where the zero deductible part shines. 2 weeks later, an envelope arrives. It's not a bill from the hospital. It's an explanation of benefits from his insurance company. He opens it and his heart sinks. Total cost of MRI, $3,000. Amount paid by insurance, $2,400. Amount he owes, $600. He immediately calls the insurance company, his voice tight with frustration. There must be a mistake, he says. I have a zero deductible plan. Why am I being billed $600 for an MRI? And this is where the second landmine, coinsurance, detonates. The agent on the phone is calm, patient. She's had this exact call 1,000 times. I understand your confusion, sir. Your plan does have a $0 deductible, which is great. That means your plan starts paying its share from day one. However, your plan also has a 20% coinsurance for diagnostic imaging. Mark is silent. The agent continues, coinsurance is the percentage of the cost you share with your insurance company after your deductible is met. Since your deductible is $0, your coinsurance kicks in immediately. The total cost was $3,000. We paid our 80%, which is $2,400. You're responsible for the remaining 20%, which is $600. The reality hits Mark like a ton of bricks. His zero deductible plan didn't mean he paid $0. It just meant he skipped the deductible phase and went straight to the cost-sharing phase. He hangs up the phone feeling cheated. He's already out $675 for a sprained ankle, and he doesn't even have a diagnosis yet. The news from the MRI is bad. He has a complete tear of his anterior talofibular ligament. He needs surgery. Now the numbers get truly terrifying. The surgeon, the anesthesiologist, the facility fee. The initial estimate for the procedure is $50,000. Mark does the math in his head, his hands starting to sweat. 20% of $50,000 is $10,000, plus the $675 he's already paid. He's looking at a bill of nearly $11,000. On a zero deductible plan, the VIP pass he thought he bought just led him to a different, very expensive line. He feels like a fool. He feels trapped. The high premium he pays every month feels like an insult on top of injury. This is the moment of absolute panic. This is where people lose their savings, where a simple sports injury becomes a life-altering financial crisis. But this is also where the third and most important number on his insurance card comes into play: the out-of-pocket maximum. Mark calls his insurance company again, this time not with anger, but with desperation. He explains the situation, the impending $50,000 surgery, and the $10,000 coinsurance he can't possibly afford. The agent asks him to find the out-of-pocket maximum on his plan details. Mark finds it, $8,000. Mr. Henderson, the agent says, that number is your financial shield. It is the absolute total most you will pay for in-network medical care in a single year. Period. She then walks him through it, and for the first time the whole picture becomes clear. Think of it like a bucket, she says. Your out-of-pocket maximum is an $8,000 bucket. Every dollar you spend on copays and every dollar you spend on coinsurance goes into filling that bucket. You paid a $75 copay, so you've put $75 in the bucket. You then paid $600 in coinsurance for the MRI. Now your bucket has $675 in it. Your remaining out-of-pocket responsibility for the rest of the year is $7,325. Mark is listening, barely breathing. Now, she continues, your surgery is $50,000. Your 20% coinsurance would normally be $10,000. But you don't pay $10,000. You only pay until your bucket is full. You will pay $7,325 towards that surgery. Once you do that, your $8,000 out-of-pocket maximum for the year has been met. Your bucket is full. For the rest of the year, for any other covered, in-network medical care you need, physical therapy, follow-up visits, even another unrelated surgery, we, the insurance company, will pay 100%. You will pay $0. A wave of relief washes over Mark. It's a complicated, bittersweet relief. He's not getting away with a free ride. An $8,000 ankle sprain is still a massive, painful expense. But it's not the catastrophic, life-ruining bill he was imagining just minutes before. He now understands. The zero deductible plan wasn't a magic shield against all costs. It was a trade-off. He paid a higher premium to eliminate a front-end deductible, but he was still on the hook for a series of smaller costs that were capped by a financial failsafe he never even knew he had. Mark's story isn't an edge case. It is the fundamental reality of how these plans work. It reveals that the term zero deductible is less of a promise and more of a starting point. It's the beginning of a different financial journey, one governed by copays, coinsurance, and ultimately, a single number that acts as your final line of defense. Understanding this journey is the key, but it begs the most important question of all. If this is how it works with all its hidden costs and complexities, who on earth is a zero-deductible plan actually for? It's a question that cuts right to the heart of the paradox. Why would anyone willingly pay the highest possible monthly price for health insurance? It seems counterintuitive, almost financially irresponsible. It's like paying for a Ferrari's monthly lease payment when you only drive a Toyota. But the answer isn't found in a simple spreadsheet. It's found in the human mind, in our relationship with risk, and in the unpredictable reality of our own bodies. A zero-deductible plan isn't for everyone. In fact, it's for a very specific type of person, and you might be surprised to find you're one of them. Let's meet the first person. We'll call her the peace of mind seeker. This person's greatest fear isn't the high monthly premium. It's the unknown. It's the letter in the mail with a hospital logo on it that could say they owe $500, or it could say they owe $8,000. That uncertainty is a constant, low-grade stress that hums in the background of their life. For them, a high premium isn't a cost. It's a subscription. It's a fixed, predictable fee for the complete and total removal of that specific anxiety. They know with absolute certainty that if they break their leg, get a sudden illness, or need an unexpected procedure, the financial conversation begins and ends with their copay. $25 for a specialist. $100 for the emergency room. Done. The high monthly premium is the price they pay to sleep at night. They've essentially prepaid for their peace of mind, transforming a volatile, terrifying risk into a boring, manageable line item in their monthly budget. It's the all-inclusive resort of healthcare. You pay a premium upfront, but once you're inside, you don't have to pull out your wallet for every little thing. Then there's the second person, and for this person, the math actually starts to make sense. Let's call him the healthcare frequent flyer. This is someone living with a chronic condition like diabetes or Crohn's disease, or perhaps a family with a child who has asthma and needs regular specialist visits and multiple prescriptions. They know they're going to use their insurance a lot. For them, a high-deductible plan is a ticking time bomb. Let's run the numbers. Imagine a family with a standard plan that has a $6,000 family deductible and premiums of $500 a month. That's $6,000 a year in premiums. But because of their constant need for care, specialist visits at $400 a pop, physical therapy sessions, and a monthly prescription that costs $800, they blow through that $6,000 deductible by April. So in the first 4 months of the year, they've paid their premiums plus $6,000 out of pocket. Their cash flow is destroyed. For the rest of the year, they pay coinsurance on every service until they hit their out-of-pocket maximum, maybe $12,000. Their total healthcare spending for the year could easily reach $18,000. Now let's look at their other option, a zero-deductible plan. The premium is much higher, let's say $1,200 a month. That's $14,400 a year. Sounds like a lot more. But watch what happens. From day one, every specialist visit is just a $40 copay. The expensive prescription is a $50 copay. The physical therapy is a $20 copay. There is no massive $6,000 hurdle to clear. There is no financial shock in the first quarter of the year. Their total spending is just the high premium plus a few $100s in copays over the entire year. Their total cost might be around $15,000. In this very real scenario, the zero-deductible plan is not only less stressful and more predictable, it's actually $3,000 cheaper. For the frequent flyer, a zero-deductible plan isn't a luxury. It's a strategic financial tool to manage high recurring medical costs. And that brings us to our third and perhaps most compelling profile, the risk-averse family planner. Think of a young couple planning to have their first child. The average cost of childbirth in the United States, without complications, can range from $10,000 to $20,000. With a high-deductible plan, the moment they check into the hospital, they are on the hook for their entire deductible instantly. A $7,000 bill could arrive right when they're buying diapers in a crib. It's a massive financial hit at a vulnerable time. But with a zero-deductible plan, the prenatal visits are simple copays. The delivery itself might have a fixed copayment of, say, $500. That's it. The rest of that $20,000 cost is absorbed by the plan they've been paying for all year. They've effectively amortized the massive cost of childbirth over 12 higher monthly payments, transforming a potential financial crisis into a predictable, planned expense. For anyone facing a major planned medical event, a knee replacement, a necessary surgery, or starting a family, the zero-deductible plan acts as a powerful buffer against financial shock. So, if these plans are perfect for these three types of people, who are they absolutely wrong for? This is just as important. If you are young, healthy, and your doctor's office has to send you a reminder just to get you in for an annual checkup, a zero-deductible plan is financial malpractice. You would be paying thousands of dollars in extra premiums for coverage you will almost certainly never use. It's like buying flood insurance in the middle of the desert. For you, a high-deductible health plan, especially one paired with a health savings account or HSA, is a far superior strategy. You pay a rock-bottom premium, and the money you save can be invested into an HSA, which gives you a triple tax advantage. The money goes in tax-free, it grows tax-free, and it comes out tax-free for qualified medical expenses. It's a retirement account and a medical emergency fund rolled into one. Likewise, if you are a financially disciplined person with a robust emergency fund, say $10,000 or more sitting in a savings account specifically for this purpose, you can afford to take the risk. You can self-insure your deductible. You're making a calculated bet on your own health. By choosing a low-premium, high-deductible plan, you are saving hundreds, maybe thousands of dollars a year. If you stay healthy, you win the bet, and that money stays in your pocket to be invested or saved. If a medical emergency does happen, you're prepared. You can write the check for your deductible from your emergency fund without derailing your financial life. So how do you decide? How do you cut through all the noise and find the right answer for you? Comes down to a simple three-question test. First, what is your health forecast for the next 12 months? Be brutally honest. Are you expecting clear skies? Or are there storm clouds on the horizon? Think about your own health history, your family's needs, any planned procedures, or the possibility of starting a family. Your anticipated usage is the single biggest factor in the equation. Second, what is your financial psychology? This isn't about numbers, it's about feelings. Does the thought of a surprise $7,000 bill give you a panic attack? Or does the thought of willingly overpaying by $200 every single month make you physically ill? One person's security is another person's waste. Understanding your own tolerance for risk and your emotional response to financial uncertainty is critical. And finally, question 3. Can you pass the sudden bill test? I want you to do this right now. Picture a bill arriving in your mailbox tomorrow. It's for the full amount of your potential deductible. Let's say it's $8,000. Do you have the cash right now to pay it without going into credit card debt, taking out a loan, or raiding your retirement savings? If the answer is a confident yes, you have the financial freedom to consider a high-deductible plan. But if the answer is no, or even a hesitant maybe, then the high premium of a zero-deductible plan isn't just a payment. It's your shield. It's the armor you buy to protect your financial life from the chaos of the American healthcare system. In the end, the term zero-deductible is a misnomer. It doesn't mean free. Nothing in this system is free. It simply means you've chosen to pay your share up front, in predictable installments, rather than in a terrifying lump sum when you're at your most vulnerable. There is no universally best plan. There is only the plan that best aligns with your health, your finances, and your peace of mind. The goal was never to convince you to buy a zero-deductible plan. The goal was to give you the knowledge to see these plans not as confusing products but as tools. And now you have the framework to pick the right tool for the job, to walk into open enrollment not with fear, but with confidence, and to take control of the one thing that matters most: your health and your future.